Welcome to Manager EDU. Today, I will teach you the profit margin ratio. I will define the ratio, clarify its formula, show an example, and clear your concept about what the profit margin ratio value means. So, let's get started. Profit margin measures the percentage of profit a company earns for each dollar of revenue generated. For example, when a company makes sales, we compare its net profit to its net sales to see how much the company earned per dollar of sales. If the profit margin ratio is higher, it is a good sign for the company because it means the company is keeping more profit from each dollar of sales. If it is lower, it is not a good sign, as it indicates the company is earning less profit relative to its revenue. Now, let's explain its formula. Profit margin equals net income divided by net sales. Sometimes we multiply the result by 100 to express it as a percentage. Let's use the formula in an example. Suppose we have this income statement for a company called ABC. Revenue, $1 million. Cost of goods sold, $400,000. So gross profit equals $600,000. Operating expenses, $250,000. So EBITDA, earnings before interest, taxes, depreciation, and amortization, equals $350,000. Depreciation and amortization, $50,000. So EBIT, earnings before interest and taxes, equals $300,000. Interest expense, $50,000. Taxes, $100,000. So net profit equals $150,000. Now we apply the profit margin formula. Net income, $150,000, divided by revenue, $1 million, equals 0.15. When we multiply by 100, we get 15%. So the profit margin in this example is 15%. Now, let's learn what the value 15% means conceptually. In the above example, a profit margin of 15% means that out of every $1 of revenue the company earns, 15 cents is profit. In other words, for every $100 in sales, the company keeps $15 as profit after covering all its costs and expenses. You can think of it this way. If the total revenue is represented as 100%, then 15% of that revenue is the profit the company has earned for the whole year. The profit margin is one of the most widely used ratios in finance because it directly shows how profitable a company is. It is very easy to understand and apply. If you didn't fully understand, you can watch this video again. Thanks for watching.